Hi CA students, let's revise CFN AFM Chapter 5 Security Valuation. Practical question 12. Following financial data are available for PQR Limited for the financial year 2008. They have given 8% debentures 125 lakhs, 10% bonds 50 lakhs, equity shares of 10 each 100 lakhs, reserves and surplus 300 lakhs. Then total assets 600 lakhs, assets turnover ratio they have given. Then effective interest rate of 8% and effective tax rate of 40%. Operating margin is 10%. Dividend payout ratio 16.67 and current market price is 14. Required rate of return of investors is 15%. They are asking us to first draw income statement for the year. So the income statement will be sales minus operating expenses. We will get operating margin or EBIT minus interest. Then we will get we will get earnings before tax, then minus taxes, profit after tax, then equity dividend will get retained earnings. This will be our income statement for the year. Okay, now for this we now know that operating margin is 10%, so the operating expenses will be 90%, and we need sales. For that we can take assets turnover ratio and total assets. If we do reverse calculation, we'll get sales as 660 lakhs. So sales divided by total assets equal to asset turnover ratio 1.1. We cross multiply, we'll get 660 as sales. Then as we know, operating expenses 90%, then operating margin 10%, so we will get EBIT as 66. Now interest, they have given effective interest rate as 8%, so we have to total our debentures and bonds, then multiply with 8%. Now we might have a question that why we are not taking 8% into 125 and then 10% into 50. That interest rate will come up to 15 lakhs, but we should not take that, since in the question they have mentioned that effective interest rate is 8%. We should consider 8% only. This is because effective interest rate covers all those premiums and then compounding effect and transaction cost, all those things the effective interest rate will take care. But this 8% and 10% will not take care of those things, as it is simply what they are paying to the debenture holders and then paying to the bond holders. So let's say in this case we are getting 15 lakhs as the interest rate, which will be the actual cash outflow. But in case of income statement, if you consider, we should account for whatever is the effective interest rate, so which they have given 8%, so we should take 8% only. So that is clarified. Then earnings before tax is 52, then taxes they have given 40%, and then profit after tax is 31.2. Equity dividend they have given 16.67%, so that also is considered 5.2. Retained earnings, which is undistributed profits, which will be 26 lakhs in our case. So income statement is done. Now sustainable growth rate of earnings they are asking. Sustainable growth rate is SGR, which will be ROE multiplied by 1 minus retention rate. So in our case 1 minus dividend ratio into B actually. So 1 minus dividend ratio or ROE 1 minus dividend payout ratio. So we need return on equity. So return on equity is nothing but profit after tax divided by net worth. So in our case, net worth is this 100 plus 300, 400. Then profit after tax, which we have already calculated in our income statement, 31.2. divided by 400, we'll get 7.8% as the return on equity. Now that if we multiply with the retention ratio, which is nothing but 1 minus 0.1667 of dividend payout ratio, so we are getting 6.5% as the sustainable growth rate. Then coming up next, they are asking us to calculate fair value of company share using dividend discount model. So that is simple, since we know that dividend, then we have to multiply the dividend with the growth rate. So we know the dividend as 5.2 divided by 10 we have to take, which is sorry, 1 minute. So the dividend, equity dividend is 5.2, which is for entire equity shareholders, and we have to divide it by the number of shareholders. Here in our case 100 lakhs divided by 10 each will give us so 10 lakhs will be the number of shareholders. So 5 lakh 20,000 divided by 10 lakhs will get 0.52. Then 0.52 multiplied by the growth rate divided by KE minus G. So it will give us the fair price of the company share, which is 6.51. Now they are asking what is your opinion on investment. So this 15% is considered, this also is considered. What is your opinion on investment in the company share at current price? So the current price is coming up to 6.51, but as we can see current market price of the share is 14. So the theoretical market price is 6.51, but the actual market price is 14. So the share is overvalued. Hence investors should not invest in the company, or if we have already invested, then it is better to sell the shares right now. Thank you.